All right, bosses. First lesson of the day. Loans. The magic trick that makes broke people feel rich and rich people look smarter than they actually are. Picture this. You're scrolling through listings and spot your dream car. It's matte black and looks like it could outrun your problems. Price tag, $40,000. Wallet, $800 and a half-eaten sandwich. Then the dealer hits you with that magic phrase, "No worries, we can finance it." Translation, you get the car today and your future self gets the bill. That's a loan. When you borrow money now and promise to pay it back later, but the bank's not out here doing favors. They're charging you interest, which is basically rent for money. And trust me, their rent makes New York apartments look cheap. Let's do some boss math. Borrow $40,000 at 7% for 5 years, and you'll end up paying around $47,000 total. That's $7,000 extra just for borrowing. That's a vacation, a business startup, or about 400 iced lattes gone. Miss a payment, and it gets uglier. Fees, penalties, and your credit score takes a swan dive. That boss car you were flexing, it starts looking like a bad investment with leather seats. But not all loans are evil. Student loans can be a bet on your future self. Just make sure your degree can actually pay the bill. Mortgages help you buy a home and technically let the bank own it until you finish paying them back. Here's the golden rule. Borrow only what you can comfortably pay back. If that monthly payment makes you break into a sweat before payday, that's not a loan, that's a leash. A true boss doesn't borrow to look rich. They borrow to get rich. All right, bosses, you now know what a loan is. But here's the twist. Before the bank decides if you even deserve one, they check your credit score. Think of it like this. You're trying to borrow your friend's car. Before they toss you the keys, they're thinking, does this guy drive responsibly or does he treat red lights like they're optional? That's exactly what a credit score does for lenders. It's your financial reputation score, one number that says, can we trust this person with money? Scores range from 300 to 850, below 580, and lenders see you like a risky investment. Above 740, and they might start offering you money like you're their long-lost cousin, the one they actually like. Now, here's the boss breakdown of how that score is built. Payment history, 35%. Do you pay bills on time or treat due dates like rough suggestions? Credit utilization, 30%. Are you maxing out your cards like it's Black Friday every day or staying chill under 30%? Credit age, 15%. How long you've been in the game. Fresh credit looks risky. Seasoned accounts build trust. Credit mix, 10%. A balanced combo of loans, cards, maybe a mortgage. Shows you can handle different money moves. New credit, 10%. If you're applying for 5 cards in 1 week, slow down and take a break, boss. You're not building credit, you're building suspicion. Now here's the part most people don't get. Your credit score doesn't measure how rich you are, it measures how reliable you are. You could be rolling in cash, but still have a trash score if you don't treat your bills right. Think of it as your money resume. It's what lenders check before deciding if they want to hire you with their money. Ignore it, and one day you'll be paying 27% interest on a used car, wondering why adult life feels like a scam. So build it early, protect it always, because when it comes to money, trust is credit, and credit is power. All right, bosses, let's talk assets. That's the fancy finance word for stuff you own that actually has value. If money is the fuel for your empire, assets are the engines that keep it running. Your car, asset. Your house, asset. Your savings account, your investments, even that side hustle bringing in passive income. All assets. But here's the catch. Not all assets are created equal. See, some appreciate, they grow in value over time. Others depreciate, they lose value the moment you buy them. Example, a car is technically an asset. It's something you own. It has resale value. But it's a depreciating asset. That means every mile you drive, every French fry that falls between the seats, your car's value slowly drops. On the other hand, a rental property or a dividend-paying stock is an appreciating or income-generating asset. They either go up in value or put cash in your pocket while you sleep. That's what we call cash flow, boss. The trick is stacking the right kind of assets, the ones that work for you, not against you, because rich people don't buy shiny things. They buy productive assets that make them money while they're out golfing. So next time you're about to make a big purchase, ask yourself, is this building my wealth or just burning through it? Even that brand new car? Cool flex. But it's not making you richer. It's a lifestyle expense disguised as an asset. The real boss move? Build a portfolio of assets that appreciate, diversify your holdings, and let compound growth do the heavy lifting. Let's talk about the biggest loan most people ever take, the mortgage. That's right, the heavyweight champ of debt. Picture this. You find your dream house. It's got the backyard, the fancy kitchen, and enough space for the ego you've been building. Price tag, $300,000. Bank account, let's just say you've got $2,000 and a dream. Enter the mortgage. A mortgage is basically a supersized loan made just for buying property. The bank says, we'll cover the $300,000 you just pay us back over the next 30 years. With interest. Sounds nice, right? You get the house, the picket fence, maybe a dog. But here's the twist. When you buy with a mortgage, you don't truly own that house. Yet, the bank does. You're just renting from them, except this rent comes with paperwork and property taxes. Miss a few payments, and the bank can foreclose. That's a fancy word for taking back what's technically still theirs. No drama, no debate, they just own it again. Now, mortgages are designed to be affordable, meaning you pay monthly installments, usually a mix of principal, the actual house price, interest, the cost of borrowing, sometimes insurance and property taxes, all rolled into one neat little financial headache. Here's the part most people don't realize. In the early years, most of your payment goes straight to interest. You barely touch the principal. It's only later, usually after several years, that you start actually owning a bigger chunk of your home. Done right, a mortgage can be a wealth-building tool. Real estate often appreciates over time, meaning your home could increase in value while you're paying it off. That's called equity, the portion of the house you truly own. Done wrong? It's a 30-year chain made of debt, interest, and regret. So before you sign those papers, ask yourself, am I buying a home or a long-term payment plan with a roof? Be smart, boss. Use a mortgage to build wealth, not just to look wealthy. All right, bosses. Now that you know how mortgages can build or bury wealth, let's talk about the lifeblood of it all, income. Because no matter how smart your financial plan looks on paper, if money isn't coming in, it's just a motivational poster. Income is simple. It's the money flowing into your life, but the type of flow. That's what separates a worker from a boss. Let's break it down. Earned income, that's when you trade time for money. Your 9 to 5, your Uber shifts, your side hustle. You show up, you get paid, you stop showing up, the money stops too. It's simple, but it's also capped. You only have 24 hours in a day, and trust me, working all of them doesn't make you Jeff Bezos, it makes you tired. Passive income, now this is where the bosses play. This is money that shows up even when you're not clocking in. Rental income, dividends, royalties, business ownership, basically, you become the asset. Then there's portfolio income money from investments. Your stocks go up, your crypto grows, hopefully, or you cash out on a business you built. This is how wealth scales, not just through work, but through ownership. Here's the mindset shift. Most people chase bigger paychecks. Bosses chase multiple paychecks. One income stream pays the bills, but multiple streams build the empire. And don't get it twisted, it's not about overnight success. It's about building systems that pay you while you sleep. Because if your money isn't working for you, you'll be working forever. Remember, bosses make money work for them. All right, bosses, you've got your income flowing in. Now it's time to talk about what's flowing out. The silent empire killer, expenses. Think of your money like water in a bathtub. Income fills it up. Expenses. Those are the leaks, cracks, and holes that drain it dry when you're not looking. Your rent, your groceries, your bills, those are normal. But then there's the sneaky stuff. That gym membership you swear you'll use. The 6 streaming services you need for relaxation. And those 2 a.m. impulse buys because apparently you really did need that glow-in-the-dark keyboard. Here's the breakdown. Fixed expenses, rent, car payments, insurance. They're predictable. They're steady. They don't care if you're broke or balling their due. Variable expenses, takeout, clothes, random subscriptions, these are the sneaky ones. They creep up until your card starts sighing. Most people say, I don't spend that much. Then they check their bank statement and realize all the coffee they bought alone could have bought them a small car. Now, don't get me wrong, spending money isn't evil. We work hard, we deserve nice things, but there's a difference between living comfortably and leaking cash. Here's the boss rule. Know the difference between needs and wants. You need food, water, and shelter. You want designer sneakers, daily takeout, and buy random things you'll never use. If your expenses grow faster than your income, you'll always feel broke even when you're not. Control the leaks, and suddenly your bathtub fills faster than you can spend it. Because the real flex isn't how much you spend, it's how much you keep. Bosses, it's time to face one of life's guarantees, taxes, because no matter how much you earn, save, or hustle, Uncle Sam's got your number and he's calling every payday. You work your tail off all month, see your paycheck hit your account, and wait, where's the rest of it? You thought you were getting $2,000, but your bank balance says $1,400. That missing $600, congratulations, you just paid your membership fee to society. Taxes are how the government collects money to fund things like roads, schools, emergency services, and that one park you still haven't visited. They're not punishment, they're part of the system. If money runs the world, taxes are the toll booths. Now, there are a few main types of taxes you'll bump into. Income tax, taken straight from the money you earn at your job or business. Sales tax added when you buy things. The price tag says one number, the register says surprise. Capital gains tax charged when your money makes more money, like when you sell stocks or property for a profit. In short, every time money moves, the government takes a small slice. Now here's what every boss needs to know. Taxes are unavoidable, but understanding them is power. Know what's being taxed, when it's taken, and why. Because the more you understand how money flows, the easier it is to plan, save, and grow your wealth the smart way. All right, bosses, let's talk stocks. The magic word everyone throws around when they say, I'm investing. But what are they really? Think of a stock as a tiny piece of a company. When you buy one, you're not just holding paper, you're buying ownership, a slice of the business pie. If the company grows and makes money, your slice can grow in value too. So why do companies sell stocks? Simple, they want cash to expand, hire, build, and chase bigger dreams. Instead of borrowing from banks, they raise money by selling small ownership shares to investors. Now, here's how you, the investor, make money. Capital gains when the price of your stock goes up over time, and you sell it for more than you paid. That's called appreciation. Your little slice just got more valuable. Dividends when a company decides to share part of its profits with investors. Think of it like a thank you check for believing in the business, but don't get it? Twisted stocks don't rise in a straight line. Prices move up and down constantly. That's called volatility. It's normal, and it's part of the game. All right, bosses, you've heard the phrase, make your money work for you. Well, this is how it actually does that. Meet the money multiplier, compound interest. Sounds fancy, but it's just interest earning more interest over and over, like a snowball rolling downhill and getting bigger every time. Let's break it down simple. You start with $1,000 and it earns 10% interest in a year. Now you've got $1,100. Next year, you don't just earn interest on the original $1,000, you earn it on the full $1,100. $1,100. So now it's $1,210, then $1,331, and it keeps stacking quietly, consistently, like money doing push-ups while you sleep. That's compound growth, your returns earning their own returns. It's not flashy, but it's powerful. Give it time, and that small amount turns into something huge. Now, here's the thing most people miss. Compound interest works both for you and against you. When you invest, it works for you. Your money grows faster the longer you leave it alone. That's why time in the market beats trying to time the market. But when you're in debt, it works against you. Skip a few payments, and suddenly you're not just paying interest on your balance, you're paying interest on your interest. That's how a small debt becomes a financial black hole. So here's the boss truth. Compound interest rewards patience, not impulse. Start early, stay consistent, and let time do the heavy lifting. Because the earlier you start, the harder your money works. And in the world of money, time isn't just money, it's the boss of money. Now let's talk bonds. They might not sound exciting, but trust me, these quiet little contracts keep entire economies running. Here's the deal. A bond is basically an IOU, promise that someone will pay you back with interest. Governments, cities, and companies use them to borrow money. You lend them your cash now, they pay you interest regularly, and then give your full amount back later. Think of it like this. Your friend says, lend me $100, I'll pay you back in a year plus $5 for the trouble. In essence, that's sort of how a bond works, and they come with two main benefits. The first is stability. They don't jump up and down like stocks do. They're more predictable. That's why investors call them fixed income. The second benefit is income. Most bonds pay interest at regular intervals called coupon payments. You're basically collecting rent from whoever borrowed your money. Now, not all bonds are created equal. Some are super safe, like lending to the government, because they rarely miss a payment. Others come from corporations higher risk but usually higher reward. The key word here? Risk. The higher the risk, the higher the interest rate they offer to convince you to lend. It's like financial dating. The sketchier they look, the more they promise to keep you interested. But here's the boss rule. Bonds aren't about getting rich. They're about balance. When markets get wild, bonds help keep your portfolio calm and steady. Because real wealth isn't just about chasing gains, it's about protecting what you've already built. So while everyone's busy trying to double their money overnight, sometimes the smartest move is the safest one. Now it's time for the other side of the balance sheet, liabilities. If assets are what you own, liabilities are what you owe. It's your debts, your payments, your promises to pay. Later, all the stuff that looks fine on paper until the bill shows up. Let's break it down. Credit card balances, liability, mortgage, liability, student loans, car loans, unpaid bills, all liabilities. Basically, if it has your name on it and a due date, it's a liability. Now, don't panic. Not all liabilities are bad. Some can actually help you build wealth. A student loan that gets you a better paying career, that's a strategic liability. A mortgage that helps you buy a home that appreciates in value, that's leverage. But maxing out a credit card for retail therapy, that's not leverage, that's financial self-sabotage. Here's how the boss looks at it. There are two kinds of liabilities, productive and destructive. Productive liabilities help you earn more or gain long-term value. Destructive liabilities drain your income and offer nothing back. The trick is keeping your liabilities in check, using them intentionally. Because debt can build your empire or burn it down. You don't have to fear liabilities. You just have to control them. Use them to grow your assets, not fund your impulses. All right, bosses, this is it. The big one. The scoreboard of your financial game. Net worth. It's not about how much you make, it's about how much you keep. Here's how it works. Take everything you own that has value, your assets, then subtract everything you owe, your liabilities. What's left? That's your net worth. It's the real measure of your financial health, not your salary, not your car. Not that luxury couch you financed for 36 months because it matched your vibe. If you've got $200,000 in assets and $150,000 in debt, your net worth isn't $200,000, it's $50,000. You could be pulling six figures and still be in the negative if your expenses eat every dollar that comes in. Meanwhile, someone earning half as much but saving, investing, and staying disciplined could be miles ahead. That's the part most people miss, is that wealth isn't all about income, it's about ownership. Your goal as a boss, grow that net worth over time, stack appreciating assets, cut liabilities that drag you down, and track it because what you measure, you can manage. The best part? Watching that number grow because of smart moves you made. That's when you realize you're not just working for money, your money's finally working for you. So whether your net worth right now is a mountain or a molehill, the only direction it should be going is up. Because at the end of the day, my fellow bosses, you're not chasing paychecks. You're building an empire. If you found the video useful, remember to subscribe. Stay profitable, boss.